Let's connect with our expert now, and we are being joined by Vinay Paharia, who is the CIO at PGIM India Mutual Fund. Hi Vinay, very good afternoon. This is Shrishti Sharma. Great to have you on the show. And Vinay, the day that we are interacting with you, there's been a very interesting setup in the Asian markets. Look at the recovery in China on the back of latest news flow. Indian markets are seeing a bit of a profit booking, what we can call it, and the Japanese market are also under pressure on the back of the political development. Given the kind of setup that we are in with respect to what's happening in the global and the US markets as well, Vinay, help us with your take. How do you see India placed, and going ahead, what kind of fund flows can we expect given the kind of recovery that we are witnessing in China? Vinay, if you can unmute and help us with your take.
I'm sorry. Hi, thanks, Srishti, for having me on your show. So in the last few months, we have seen volatility significantly go up, not only in India but globally, led by various political monetary developments. China, we had seen a significant economic slowdown, and as a result, there has been a substantial monetary stimulus given by the government, and the markets clearly seem to be reacting to that. While on the other hand, in Japan, we are seeing the reverse. We are seeing a monetary tightening in Japan, which is effectively causing the popular yen carry trade to reverse. And in India, we are seeing a reversal of the popular trade where low growth companies were actually seeing a significant returns compared to the higher growth ones. So I think a lot of these trades are reversing, and there is a churn which is happening internally in the markets. So while the short term, it all appears very chaotic, if you zoom out on a longer run basis, there is order to a lot of these developments.
All right, but which are the sectors or the pockets where do you find opportunity? Because I was just reading your notes or your take on the markets. You believe that the falling interest rate scenario could positively impact the high growth companies. So if you can highlight some of the sectors that are looking attractive to you right now.
Sure. So I think before going into the sectors, it's important that we look at the internal churn in the market. So even within sectors, there are companies which are high growth companies and there are companies which are low growth companies. So for example, in the last 1 year, if you just look at the large cap segment of the market, the top 100 companies, the companies which gave the top 20%, the top 20 companies which gave highest returns actually had just 8% compounded sales growth in the previous 10 years. Whereas the bottom 20 companies actually delivered 12% compounded sales growth in the previous 10 years. So the point which I'm trying to highlight is, irrespective of the capitalization, we are clearly seeing a trend which was there in existence in the last year where low growth companies were doing much better. And that was largely because interest rates were going up. And interest rate increase is actually significantly damaging for high growth companies. And now in the environment when the interest rates have started to fall, especially this is led by developed world and more by US Fed and ECB, we are going to see, and we have already started seeing, high growth companies delivering superior, significantly better returns, and it started since the last 3 months. So coming back to your question on the sectors, some of the sectors where we are seeing many of these high growth companies prevalent include the healthcare sector, consumer discretionary sector, some companies within the financial services, particularly the private sector banks, high growth NBFCs, so on and so forth. But in general, I would say that wherever you are seeing companies which have an ability to grow on a sustainable basis at a higher rates of growth, those companies would materially outperform companies which can potentially grow at a much lower growth rates.
All right, but Vinay, also help us with your take on the metal pack, because there's been a substantial recovery for not just some of the private players, but some of the PSU counters, which were actually beaten down names in the recent while. They have also started recovering with the kind of news flow that we have around with respect to China. What's your take, Vinay? Do you believe that it is now the time to look at metals in a constructive fashion?
I think, Shrishti, the problem with metals is that these are very, very cyclical and very, very dependent on the underlying commodity prices. And forecasting the long term trend of these prices is also very, very difficult. Even the promoters of the company would find it extremely difficult to forecast the long term trends, because of which it is difficult to judge whether or not these companies would be making higher returns on capital on a sustainable basis. And also, in aggregate, most of the commodity oriented companies tend to make subpar returns on capital, which is why this is a segment where we are not particularly very gung ho on, and it's difficult for us to take a call on. But of course, these are companies where some people have good specialization in, and probably they might be better placed to take calls on them.
But when one more point that I was trying to find an answer to is that though China has been the biggest producer and consumer for all the metal counters, and it's good to note that the kind of recovery that the Indian companies are undergoing. But any next sector to watch out for, Vinay, with respect to China opening up and the kind of policy measures that they have, because a lot of these measures have been announced with respect to gaining back their consumption. So if that pans out, any sector that could be linked to this China story and investors could be beneficiary of that?
I think, Srishti, it's important to realize that we should not react to a lot of these triggers. Remember, there have been many false starts for China. They have tried to stimulate their economy multiple times in the previous year, and many of these measures have not resulted in adequate and desired outcomes. So I would not want anyone to jump the gun too soon, and importantly, focus on longer term structural trends. Clearly, Chinese economy has seen a structural slowdown. This is an economy which is dependent on very, very low return on capital. So the high economic growth was driven by increasingly higher levels of capital employment. So it was a low return on capital economy, and hence, I think incrementally it will be seeing a structural slowdown. The demand is likely to remain weak, and hence we would be cautious in jumping the gun on this China recovery trade. And in fact, we would not want to make any such short-term trades as well, and I would not want to advise that to your viewers as well.
All right, Vinay. Totally take your point. There has been a lot of false alarms, or you can call it a lot of news flow around China opening up. Let's see how this pans out this particular time. But Vinay, before we wrap this discussion with you, the last time, on a YTD basis, Nifty 50 has given high teen return. So, Vinay, let me just ask you that in the next 12 months or so, what kind of a return expectation one should have on an index level front? Because given the kind of move, are we in for a double digit return, or is this a time to actually go ahead and moderate some return expectation?
I think it is very, very safe to talk about moderation of return expectation. The simple reason for that is the markets have delivered significantly higher returns compared to the underlying earnings for companies which form the market. And hence, I think it is important in general for investors to moderate their near-term return expectations, in fact, also medium-term return expectations. And also importantly, we would recommend that incrementally, if you are investing in the market, do look at only a long period investment horizon plus moderate your return expectations, because we have borrowed some returns from the future.
All right, seems like we have borrowed some returns from the future. But Vinay, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us, helping with your
Thank you.
take on the markets and the sectors that you believe can do well in the times ahead.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.